presentation which is shared on the screen right now, we have around 10 decisions that we'll be running through today, subject of course to the availability of time. We'll be discussing the ratio of these judgments and possibly what the implications are that we need to be mindful of. The first judgment is that of the Bombay High Court in the case of Larsen and Toubro versus DIT. In this case, the Bombay High Court was considering the interplay between section 916 and section 115A on the one hand and section 44BB on the other hand. The facts were like this. ONGC has the rights to extract mineral deposits from several mineral oils from several petroleum deposits. One of the deposits is at Bombay High. So ONGC wanted to set up a very elaborate infrastructure because the nature of operations is such. They had to set up a very elaborate infrastructure. One of the components of the project that had to be set up. So ONGC gave the contract to Larsen and Toubro to set up this platform. Now, in order to set up this platform, Larsen and Toubro also needed to transport some of its equipments and machines from its yard to the offshore site, that is Bombay High. Now, to transport this heavy machinery, Larsen and Toubro in turn took on hire barges and tugs from several Singapore companies. Barges are very large ships which are required to transfer these heavy equipments. Now, because they needed these barges, they had to pay higher charges. The question was, what is the nature of these higher charges in the hands of the Singapore companies? When L&T had to make this payment to the Singapore companies, it filed an application under section 195(2) before the year. The position that L&T took was that this income in the hands of the Singapore companies is covered by section 44BB of the Act. The position of the assessing officer was that it's not covered by section 44BB, but in fact, it is in the nature of a royalty income, which is taxable under section 916 at the rates given in section 115A. Now, as you all know, under 916 read with 115A, income is taxed at 10% of the gross amount, subject to increase by surcharge and education cess. So 10% of the gross sum is taxable in the hands of recipient if 916 and 115A are applied. On the other hand, if 44BB is applied, then the gross 10% of the gross receipts is considered the income, and 40% of that income is taxable. So effective tax rate is 4% under 44BB and 10% under 916 read with 115A. So the tax arbitrage was around 6%. Now, if you see the provision 44BB, it says, notwithstanding anything to the contrary contained in sections 28 to 41 and sections 43 and 43A, in the case of an assessee being a non-resident engaged in the business of providing services or facilities in connection with or supplying plant and machinery on hire, used or to be used in the prospecting for or extraction or production of mineral oils, a sum equal to 10% of the aggregate of the amount specified in subsection 2 shall be deemed to be the profits and gains of such business chargeable to tax. So the case of the L&T was that what these Singapore companies, when they give them barges and tugs, what they are doing is they are providing them services or facilities in connection with extraction or production of mineral oils. What the assessing officer said was he did not agree with the assessee's contention. His case was that the income is covered by royalty as defined in explanation 2 to section 916. He relied on clause 4 of explanation 2, which says use or right to use any industrial, commercial or scientific equipment. So AO said that these barges that you're taking on hire are nothing but industrial and commercial equipment. So this income is taxable under 916. The assessee then argued that if you read the whole clause, it's specific, it carves out an exception to say, but not including the amounts referred to in section 44BB. So even if you apply clause 4A for a moment, because of this exception, you will be taken out of royalty and sent back to 44BB. To which the assessing officer replied that what is covered by 44BB is only services or facilities in connection with extraction or production of mineral oil. So if somebody is providing services to ONGC, that is covered because ONGC is the entity which is extracting or producing mineral oils. So only the income of a contractor is covered by 44BB. The income of a subcontractor, which was the Singapore entity in this case, is not covered because the Singapore entity is giving its ships to L&T, not to ONGC. L&T is in turn providing services to ONGC. So the AO said that 44BB will not apply because the Singapore company is a subcontractor and not a contractor. The High Court ultimately decided the issue in the assessee's favor. And what they said was, first of all, they said that 44BB is a very specific provision. It's a special provision. So it will override the general provision of royalty because we are specifically dealing with extraction or production of mineral oils. So we will be covered by 44BB and not section 916. Then dealing with the assessing officer's argument that what is covered is only the income of a contractor and not a subcontractor, the High Court said that there is nothing in 44BB which suggests anything to that extent. 44BB just says services or facilities in connection with extraction or production of mineral oils. Then, in fact, the High Court said that it says in connection with. So, by using this expression in connection with, the section has a very broad connotation. If you're even loosely connected with extraction or production of mineral oils, then you can take shelter under 44BB. Your services do not have to be directly connected with extraction or production of mineral oils. Even an indirect connection is fine. That was the first reason which the High Court gave. The second point which weighed with the High Court was, they said what you have to look at is what the dominant object is. So they relied on the Supreme Court's judgment in ONGC, which was also dealing with 44D as well as 44BB, where Supreme Court had said that if your services or your facilities are inextricably connected with the given object, that is extraction or production of mineral oils, then you will be covered by 44BB. So they said that because these services of the Singapore companies of providing barges and tugs on hire, these are inextricably connected with, and the reason they say that it's inextricably connected is because without providing these services, without these barges, this equipment cannot move from L&T's side to the offshore side. So they said that it's indispensable. Without this service, the project cannot go on. So for this reason, income is covered by 44BB, and you will be taxed at the effective rate of 4% and not 10% as given in explanation 2 to section 916. Then the High Court also agreed with the assessee's point that because there is a specific exclusion carved out in explanation 2 to say that if you are going under 44BB, then you will not be covered by explanation 2. For that reason also, and also for the reason that because these services are inextricably connected with extraction of mineral oil, for both of these reasons, you will be covered by 44BB. That's the first judgment of the Bombay High Court. The next decision is of the Pune Renewable Industries SL versus ACIT. This was passed in February 2022. This decision was in fact very widely debated when it came out for a reason that just 2 weeks prior to this decision, CBDT had come out with a circular on MFN clauses. The CBDT had made some observations which the tribunal within 2 weeks struck down and said that these observations of the CBDT are not correct. There were two issues before the tribunal in this case. The first issue was that if a resident of one treaty, in this case, the assessee was a Spanish resident. If a resident wants to invoke the protocol to India-Spain treaty and then apply MFN clause, most favored nation clause, to borrow a benefit from some other treaty, can he borrow it automatically? Or does the government have to specifically notify the MFN clause every time it is to be invoked? So if you just see Protocol to India-Spain DTAA, it says the undersigned have agreed upon the following provisions which shall be an integral part of the convention. So a protocol is an integral part of the convention itself. It is not an instrument different from the DTAA. So in this case, the assessee was receiving some royalty and some FTS services, some FTS income. Under the Spanish treaty, royalty and FTS are taxable at 20%. Under 115A, royalty and FTS are taxable at 10%. Assessee wanted to invoke MFN clause and apply the treaty between India and Portuguese, which was entered into later on. So the Spanish treaty was entered in 1995, Portuguese treaty was entered in 2000. Under the Portuguese treaty, the rate of taxation for royalty and FTS is 10%. So the assessee wanted to propose this reduced rate of 10%. Although interestingly, under 115A, the rate of tax already is 10%, but the difference is that 115A rate is to be increased by surcharge and cess as the case, whereas a treaty rate is not to be increased by surcharge and cess. So the assessee wanted that benefit of waiver of surcharge and cess. So they said, we'll invoke MFN, we'll go to India-Portuguese treaty, and then we'll borrow the reduced rate of 10%. The assessing officer said that you cannot automatically go to India-Portuguese. The government has to, under section 90, the government has to notify that the Spanish residents that which seek to invoke India's treaty can now go to India-Portuguese and then borrow some benefits. For this reason, to support this proposition, the department relied on its circular, like I mentioned, circular number 3 of 2022, which had just come 2 weeks before. Even in that circular, CBDT had taken the same position that you cannot just automatically go to another treaty by invoking MFN. It has to be notified by the government. The tribunal disagreed with the department and decided the issue in the assessee's favor. Where the tribunal, first of all, said that there is that if you see section 90, and may by notification in the official gazette make such provisions as may be necessary for implementing the agreement. So the tribunal said that what is to be notified is only the treaty, only the agreement. Once the treaty is notified by the government, and because the protocol is an integral part of the treaty, it need not be separately notified. This ratio of the tribunal was in line with what the Delhi High Court held in the case of Steria, and the tribunal held that the assessee is entitled to this reduced rate of 10%, which is available in India Portuguese, and therefore 20% will not apply. The tribunal also dealt with this circular and said that the department may rely on the circular, but as you all know, it's only binding on the department, it's not binding on the assessee, and most certainly it is not binding on the tribunal. The tribunal went one step ahead to say that in any event, even if the circular was applicable, this circular has come only in the year 2022, and it's a settled principle in law that if circular imposes some additional obligations or it takes away some benefit from the assessees, then it cannot be given retrospective effect. So the tribunal said that even for that reason, the circular will not apply. Now, this position that MFN need not be separately notified and it applies automatically, it does not apply to every treaty. For example, India's treaty with Switzerland says, which also has a similar MFN clause, it says that after entering into the treaty with Switzerland, if India enters into treaty with another country, which is an OECD member, and it gives some benefit, it reduces the rate of tax or it reduces the scope of income, then MFN clause cannot be automatically imported, but the two governments, that is the Indian government and the Switzerland government, can renegotiate the treaty. If they come to a conclusion that in view of this subsequent treaty, they want to modify the terms of their treaty, only then will you import the benefit of another treaty. So this principle that the tribunal laid down in the case of GRI renewable and the Delhi High Court has laid down in the case of Steria does not apply to every treaty. You have to check the language of each treaty and then come to a conclusion that whether it can be borrowed automatically or do the governments have to subsequently sit together and again renegotiate the terms of the treaty. The second reason why the striking down of this circular was relevant is, as you all know, in the last couple of years, a very hotly debated topic is taxation of dividend income in the hands of some of the countries with which India has entered into treaty. For example, Netherlands is one. The dispute there is that the rate of tax for dividend income in India-Netherlands treaty is 10%. But India-Netherlands also has an MFN clause which says you can borrow a reduced rate of dividend from another treaty. Subsequently, India entered into treaties with 3 countries, Slovenia, Lithuania, and Colombia, where it incorporated a rate of tax at 5% only. Ordinarily, because this reduced rate was there in the subsequent 3 treaties, you could have automatically incorporated that rate in India-Dutch treaty also. But a complication was that these subsequent 3 treaties, that is Slovenia, Colombia, and Lithuania, these 3 countries were not members of the OECD when the agreements were entered into with India. So India entered into agreement with Slovenia, let's say in the year 2002. But at that time, Slovenia was not an OECD member. Slovenia only became an OECD member in the year 2005. So the position that the department was taking was that since Slovenia was not a member of the OECD at the time of entering into the treaty, MFN clause cannot apply. For MFN to apply, the treaty must be entered subsequent to entering the first treaty, and the condition. Second prerequisite is that on the date of entering into the second treaty, this other country must be a member of OECD. It cannot become a member subsequently. Last year, there were 2 judgments of Delhi High Court, one in the case of Concentrix and which was followed subsequently in the case of Nestle, where the High Court decided in the assessee's favor. And the High Court said that it does not matter at what stage you became the member of OECD. When we are invoking MFN clause, it is on that date that we have to look at these 2 things, that whether you have entered into a subsequent treaty where there is a reduced rate of taxation, and whether this subsequent treaty with the second country, that second country is an OECD member or not. The date of becoming an OECD member is irrelevant. The CBDT circular, which has been read down by the tribunal, also had stipulations to the effect so as to negate these 2 Delhi High Court judgments. This circular also said that OECD, that these 2 countries, these 3 countries had to be members of the OECD when India entered into the treaty. Now, when the dividend question in the context of India-Dutch treaty come up again, you can rely on this judgment of the Pune tribunal to say that this circular does not lay down the correct position in law, and in any event, it is not binding on India. It's only binding on the department, it's not binding on the assessees and not on the appellate authorities, certainly not on the High Court. This was the first decision, this was the first issue before the Pune tribunal. The second issue was so, for example, hypothetically, rupees 100. Over above this 100 rupees of income, it had also received certain cost-to-cost reimbursements. So, in the course of providing these services to Indian residents, it had also incurred some expenses, and these Indian residents had subsequently reimbursed these expenses to the Spanish company. So, the assessee said that when you apply section 115A and article 13, what you will tax is only the royalty and FTS income. The cost-to-cost reimbursements that have been received by me will not be taxed under 115A or article 13 because there is no element of profit. These are only reimbursements. The department said that the case of the assessee is wrong, that when you fall under the gross scheme of taxation, which is section 115A and article 13, both the section as well as the treaties say that the gross sum is to be taxed. The department said that when a gross sum is to be taxed, the entire receipt, the rate of tax is to be applied on the entire receipt. You cannot reduce a penny. There is no deduction. So whether it be cost-to-cost reimbursement or it be any other expenditure, you cannot reduce anything. If you just see the language of the section, services gross amount of royalties are to be taxed. Similarly, section 115 subsection 3 says No deduction in respect of any expenditure or allowance shall be allowed to the assessee under section 28 to 44C and section 54 and section 57 in computing his or its income referred to in subsection 1. The tribunal decided this second issue in the department's favor, and it said that the language of the section as well as the treaty is very clear that when you fall under the gross scheme of taxation, you cannot reduce anything. So even if it's a reimbursement of cost to cost expenditure, you cannot reduce the cost. What is received by you has to be simply added, and then 10% or 20% as the case may be, that is the tax rate which is to be applied. The tribunal also explained what the rationale of this scheme is. They say that if you fall under the net basis of taxation, so for example, if business profits are being taxed or if royalty is being taxed in a 44DA, at that stage, the rate of tax is high, 40%. So on one hand, they charge you in the net basis of taxation. On one hand, they charge you at a higher rate, but then they permit you to deduct expenses. So that is the scheme of net basis of taxation. But when you come under the gross basis of taxation, the rate of tax is less, so 10% under 115A. But then the flip side is that you cannot reduce anything. So the tribunal said that not only is the assessee's contention against the clear language of the section and the treaty, it also defies logic. Conceptually also, the tax rate has to be applied on the entire income and not the income after reducing any expenses. This was the second decision of the in the case of GRI. The next decision is of the Bombay Tribunal in the case of Blackstone FP Capital Partners Mauritius V Limited. This decision dealt with, which is perhaps one of the oldest issues in the international taxation arena, that is availability of benefits of India-Mauritius Treaty to a Mauritian company. In this case, the assessee was a Mauritian company, and it was a subsidiary of a company incorporated in Cayman Islands. The assessee held certain shares of an Indian company, which was sold to a company in Singapore. The assessee invoked Article 13(4) of the India-Mauritius Treaty, the old India-Mauritius Treaty, that is prior to its amendment by 2016, which said gains derived by a resident of a contracting state from the alienation of any property other than those mentioned in the paragraphs 1, 2, and 3 of this article shall be taxable only in that state. So the old Article 13(4) says that the capital gains are only taxable in the state of the transferor, the resident who has sold the shares, which in this case is Mauritius. The department said that in this case, this Mauritian company, this assessee who has sold the shares, was under the complete control of its holding company. So the holding company in Cayman Islands had funded the Mauritian company, and with those funds, this Mauritian assessee had purchased the shares. The second thing the department said was that the administrative control of this Mauritian company was also completely in the hands of Cayman Islands. Mauritian company was, the board of directors of the Mauritian company was essentially standing aside, and the decision making was in the hands of the Cayman Islands company. The third argument of the department was that even this transaction of purchase and subsequent sale of shares was only at the instance of the Cayman Islands company. The assessee had no control over what the terms and conditions of the purchase and sale were, when this transaction were to be entered into, what was to be done with the funds which were realized on the sale. So the department came to a conclusion that the Mauritian company is not the beneficial owner of shares. The beneficial owner of the Indian shares which are being sold is the Cayman Island company. And it is for this reason that the benefits of India-Mauritius Treaty will not be available. And you will be taxable under the Act. So under 911, it says that if a capital asset situated in India is being transferred, then it will be deemed to, capital gains will be deemed to have arisen in India. So department said you will be taxable under the Act. The assessee said, the assessee produced before the department its tax residency certificate, which it had obtained from the Mauritian tax authorities. The assessee relied on the two circulars of 1994 and 2000 and the subsequent judgments in Azadi Bachao and all the subsequent jurisprudence on the subject, and said that as soon as I produce before you the tax residency certificate, that is evidence enough for my entitlement to the benefits of India-Mauritius Treaty. You cannot go behind this TRC and allege other than that. The tribunal then looked at the tribunal passed a very detailed order. It saw the language of Article 13.4 and it compared that language with that of Article 10 of the treaty, India-Mauritius Treaty, which deals with dividends, and Article 11 of India-Mauritius Treaty, which deals with interest. If you see Article 10.2, it says, however, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident of that state. But if the recipient is the beneficial owner of the dividend, the tax so charged shall not exceed so and so. Similarly, Article 11.4 also says, interest arising in a contracting state shall be exempt from tax in that contracting state to the extent approved by the government of that state. So the tribunal said that wherever the government, while entering into this, wherever the government wanted to recognize this concept of beneficial ownership, they have specifically done so. That is in Article 10 and Article 11. Because in Article 13, there is no concept of beneficial ownership. So department does not have the right to say that you are not the beneficial ownership. The concept of beneficial ownership is alien to the scheme of capital gains. That is Article 13.4 of the, that is Article 13 of the treaty. The tribunal also relied on a 2014 report of UN Committee of Experts, which had again said the same thing, that the concept of beneficial ownership is completely irrelevant in capital gains. The tribunal also relied on the very well celebrated commentary of Professor Philip Baker, but also opined that beneficial ownership is irrelevant for capital gains. And lastly, the tribunal also relied on a recent judgment, which was passed in 2021 only, of the Supreme Court of Luxembourg, which had also held that the concept of beneficial ownership is irrelevant. So the tribunal said that if we were to today hold that one can look at beneficial ownership for Article 13, we will essentially be rewriting the treaty, which as one of the parties to the treaty, you cannot do. You have to respect the treaty. You cannot unilaterally amend it. The second thing that the tribunal said was that when you enter into a treaty, you are essentially, there are different choices available to you. So rights have to be allocated between the two countries. So they said that the governments have consciously exercised this choice that we will not recognize this concept of beneficial ownership, and we cannot go beyond the choice which the government has specifically exercised. So the tribunal passed the order saying that since the concept of beneficial ownership is irrelevant. Now, interestingly, this was a 7-page decision. Till pages 6, the tribunal very assertively said that the concept of beneficial ownership is irrelevant. During its decision, there is one paragraph where there are some findings of the tribunal which merit attention. I'll just read paragraph 10 of the decision. This is the last paragraph of the decision. Tribunal says, in the light of the above discussions, in our considered view, the assessing officer has clearly fallen in error in proceeding on the basis that the concept of beneficial ownership is relevant in the context of Article 13 without assigning any specific and cogent reasons in support of this inference. We are unable to approve this approach. We therefore deem it fit and proper to vacate the impugned assessment order and remit the matter to the file of the assessing officer for deciding the fundamental issue as to whether the requirement of beneficial ownership can be read into the scheme of Article 13 of the Indo-Mauritius Tax Treaty, and it is only in the event of the answer being in the affirmative that the question of beneficial ownership of the assessee in respect of the shares can be examined. So this finding of the tribunal was slightly contradictory to the rest of its decision. The question whether beneficial ownership is relevant or not is a pure question of law. Ideally, once the tribunal had decided that this concept is irrelevant for Article 13, there was really no need to send this question back to the assessing officer. If some factual determination was to be done, certainly the matter could have gone back. But for reasons to the tribunal sent even this legal question back to the file of the assessing officer, that you first give your reasons as to why the concept of beneficial ownership is relevant. And if you come to And if your answer is in the affirmative, then if the concept is relevant, then you give a finding on fact as to how Mauritius company, the SSE, is not the beneficial ownership, not the beneficial owner. Now, a question will arise as to what is the binding nature of this decision. Do we rely on the first 6 pages of the decision which say that the concept of beneficial ownership is not relevant, or do we take into consideration this last paragraph of the tribunal's decision, which has sent the legal issue back to the file of the assessing officer? In my humble opinion, this decision certainly constitutes a binding precedent for other assessees to rely upon. The first 6 pages, the 90% of this decision, does not leave anything to chance, does not leave any doubts for anyone to say that the findings of the tribunal have been made subject to anything else. The findings of the tribunal were very straightforward and very assertively and put in very strong terms that the concept of beneficial ownership is irrelevant. Now, even if we assume for a second that when this matter in the case of Blackstone goes back to the file of the assessing officer, and if the assessing officer comes to a conclusion, which in all likelihood he will, that the concept of beneficial ownership is relevant, even then we'll have these 2 documents. One will be this decision of the tribunal, and other will be the decision of the assessing officer in the case of Blackstone. So certainly whatever the assessing officer may hold in their case will not come in the way of the findings of the tribunal. So we can certainly rely upon it. It's a bit of an irony that Blackstone itself may not be able to rely on its own tribunal decision because they've sent the legal issue back to the file of the assessing officer, but other assessees will be able to rely on it. Now, as you all know, the Mauritius Treaty has since been amended. It was amended in the year 2016. So with effect from 1st April 17, if a Mauritian resident purchases any shares in an Indian company, India gets the right to tax those income. Now, it's not that income is only taxable in Mauritius. Now the income is taxable in India. Of course, one-time leeway is provided that if you purchase the shares after 1st April 17 and you sell it before 31st March 19, then the rate of tax is 50% of the regular rate. But subject to that, this decision is only relevant for old purchase of shares made prior to 1st April 17. Another interesting argument that a lot of assessees these days take is, in the case of these denial of treaty benefits, is that if you lift the corporate wheel, so in this case, if you lift the corporate wheel between Mauritius and Cayman Islands, and you say that it is Cayman Islands which is the beneficial owner of the shares, then you cannot tax the income in my hands. You cannot tax the income in the hands of Mauritius. Department has to come to a conclusion. It has to form a view whether the income is that of Mauritius or of Cayman Islands. It cannot say that for the purposes of the Act, income is of Mauritius, but for the purposes of treaty, we want to go to Cayman Islands, which does not have a treaty with India. So that's one argument which a lot of people take today, that the department has to form a conclusive opinion. If you say that the corporate wheel is lifted, then you cannot tax anything in my hands. This was the third decision. The next decision is of the Bangalore Tribunal in the case of Goldman Sachs. This decision also deals with an issue which is very contentious in international tax, that is the tax implications of secondment arrangements. In the facts of this case, the assessee wanted to set up some project was venturing into a different line of business. For that, the Indian assessee, needed the help of its group company in USA. So the Indian assessee and the group company in USA worked out an arrangement that some of the employees of USA will be seconded to India for a certain period of time. And these employees of USA will supervising and carrying out the functions which are required. And then they'll go back to USA. The Indian resident, the assessee in this case, Goldman Sachs India, directly entered into an agreement with the employees. It did not enter into an agreement with the US companies, but it entered into an agreement with the US employees which were being seconded to India. The terms of the agreement were that 25% of the salary will be paid to these employees in India, and 75% of the salary will be paid in USA to their bank account in Mauritius, to their bank account in USA for the needs of their family and other expenses in USA. Goldman Sachs India was to pay 25% directly to the employees in India, but Goldman USA was to pay 75% to their accounts in USA, the accounts of the employees in USA. After Goldman USA will make this payment of 75%, Goldman India will then reimburse the 75% back to Goldman USA, because these employees are only working for me, Goldman India. It is not to incur that cost. So after Goldman USA pays 75%, India will reimburse that cost. Now, when India filed its TDS returns, well, in its withholding obligations, Goldman India paid withheld TDS under Section 192 on the entire 100 rupees, 25 which was being paid in India and 75 which was being paid in USA. It did 192 on the entire 100. But when it had to remit this, when it had to make this reimbursement to Goldman USA, when it had to make this reimbursement to Goldman USA, it did not deduct tax at source. The assessing officer came to a conclusion that when you were making this payment of 75 rupees to Goldman USA, this was in the nature of fees for technical services under the Income Tax Act in the hands of Goldman USA, and in the nature of fees for included services in the hands of Goldman USA. So therefore, this income was taxable in the hands of Goldman USA, and you should have deducted tax at source. So proceedings under Section 201 were taken against Goldman India. Goldman India argued that what I'm paying to Goldman USA is I'm only routing the payment through Goldman USA to my employees. I am the employer of these employees so long as they are working in India. The agreement of these employees is directly with me. Their agreement is not with Goldman USA. So I am their economic employer. They are under my control and supervision. They answer to me. If there is a payment of salary, they cannot go to Goldman USA. So the case of Indian Goldman India was that the entire thing is covered by 192 and 195 will not apply because Goldman USA is not rendering any services. Assessee relied on, if you see the language of the definition of FTS in explanation to Section 917, it says for the purposes of this clause, fees for technical services means any consideration, including any lump sum consideration for the rendering of any managerial, technical or consultancy services, including the provision of services of technical or other personnel, but does not include consideration for any construction, assembly, like project, or consider, which would be income of the recipient chargeable under the head salaries. So the assessee said that in this definition of FTS, there is a specific carve out which says that if the income in the hands of the recipient is taxable in the nature of salaries, then you will go out of the definition of FTS. Similarly, the definition of fees for included services in the treaty says fees for included services means so and so. And the last paragraph says fees for included services does not include amounts paid to an employee of the person making the payment. So the case of the assessee was that both under the Act as well as under the treaty, salary income has been specifically excluded from FTS. So if I am the employer and I'm making a payment to my employee, maybe through a group company in USA, but as long as I'm making a payment to my employee, it can only be salary, it cannot be FTS. Department did not accept the assessee's case. According to the department, the income in the receipt in the hands of Goldman USA was in the nature of FTS for the purpose of the Act and in the nature of fees for included services under the treaty. The department also relied on this definition, which says fees for technical services means so and so for the rendering of so and so, including the provision of services of technical or other personnel. This to Goldman USA. In consideration, Goldman USA is providing you the services of its personnel, its employees are coming in India and working for you. So you fall within this definition. The department also relied on the definition of fees for included services in Article 12, which similarly says, including through the provision of services of technical or other personnel. So the department said that it is Goldman USA which continues to be the employer of these employees, even though they are seconded to you for the time being, but Goldman USA continues as their employer. And because these are the personnel of Goldman USA, which have been sent to you, it falls within the definition of fees for technical services as well as fees for included services. Then the department said that even if it is in the nature of cost-to-cost reimbursement, it does not make a difference. Whatever is paid has to be taxed. The tribunal eventually decided the issue in the favor of the SSE. The tribunal said that since the agreement was directly between Goldman India and the employees, Goldman India is the de facto employer or the economic employer of these people. And the income which is paid to them will be subject to tax under Section 192, which Goldman India had already done. Then the tribunal also accepted the SSE's reliance on this carve out of income which is taxable under the head salaries under explanation 2 as well as under Article 12. So tribunal said that since this income is in the nature of salaries because you are the employer, and that because there is a specific carve out, these will not be taxable in the hands of Goldman USA. The tribunal went one step ahead to say that even if for a second we assume that what is taxable, that this is FTS in the hands of Goldman USA, still this condition of clause B, that is making available of technical knowledge, experience, skill, know-how, is not satisfied. Make available, as you all know, is if the recipient of a service is able to carry out the same function with after the service comes to an end. If the service recipient is able to carry out the same function without going back to the service provider, then it is said that the technical knowledge, experience, or skill has been made available to the service recipient. So the tribunal said in this case, make available is not satisfied. So even if we accept the department's view that the income is in the nature of FTS, still it will be exempt because of clause B. Now, a couple of points are to be considered in this decision. Normally, for all interpretations under the Income Tax Act, we say that it is the substance of the transaction which has to be seen and not the form. But these secondment arrangements are, I believe, an exception to this rule, where the form of the transaction is quite relevant. You'll see wherever, so for secondment, there are several decisions against. The most prominent is Delhi High Court in the case of Centrica, and then Madras High Court in the case of Verizon, where they had said that this payment to the foreign entity is in the nature of fees for technical services. The facts in those cases was that there was no agreement between the Indian company and the employees. The agreement was only between the Indian company and the foreign company. Because there was no independent agreement between India and the employee, those high courts did not come to the conclusion that these employees are your employees, that you are the employer. Whereas in this case, the assessee entered into an agreement with the employees to substantiate its position, to further strengthen its position, that these are my employees because I've entered into these agreements with them. So although the substance of the transaction is always the same, so be it facts of Centrica or be it facts of Goldman, the substance of the transaction still remains the same, that it's the group company which is giving its employees to you for this given period of time. But because the agreements are entered differently, if you enter into an agreement with the employee, the conclusion that is arrived at is that these are your employees, so you are the employer, so 192 applies, 195 does not apply. But if you enter into an agreement with the group company and not the employees, then the high courts come to the conclusion that this is in the nature of FTS. So this is something to be careful about. If you're working on an arrangement of this nature, it's always better to have an agreement between the Indian company and the employee directly. The second point which is relevant is, in all the decisions which have come in the last 5-6 years on this issue, the department seems to be harping on as FTS only. Centrica was slightly different. Centrica was a case which came from AAI, And in that case, the AAR had come to a conclusion that when the employees of this foreign company are coming to India, they constitute a service fee of these foreign entities in India. So in that case, they were not dealing with FTS per se, they were dealing with service fee. And to the best of my knowledge, there is no other high court which has dealt with service fee. All the high courts, be it Bombay High Court in Marks and Spencer or Karnataka High Court in Abbey, all of these judgments only deal with FTS. They've not dealt with service fee. Now, if the department smartens up and they start assessing these incomes by applying service fee, then the precedent is against us. So what we can possibly do is, if you want to cut down on your exposure of service fee when you enter into these arrangements, what you can do is, in the agreement that you will enter, India will enter with either the group company or the employees, you should clarify that when these employees come to India, they'll only be performing the operations of, they'll only be looking after the business of the Indian company. They are not present in India. Your agreement should say that they are not present in India as a representative of the foreign company. Because for the constitution of service fee, it is the business of the non-resident which has to be carried on in India by its employees for a period of 6 months or so. So if your agreement will specify that the service that the employees will perform in India are not for and on behalf of the foreign company, but they'll be carrying out the business functions of the Indian company, then you will be protected against service fee. And I do believe, considering how the jurisprudence has been in the last 5-6 years, the department would eventually move to service fee and give up this claim of FTS. These are the points that I wanted to highlight in this decision. The next decision is of the Delhi Tribunal in the case of AB SAEX Pte Limited. Like I was saying, in this case, the assessee was selling its equipment either directly in India or through its distributors in India. For the entirety of sale, whatever after sale services were to be provided, whatever support services to be provided, warranty, etc., it had engaged with the distributor to provide these after sale services for all the sales, whether those sales were made directly in India or through the distributor. For everything, the distributor had only to provide these warranty services. For providing these warranty services, the assessee, which is the Singapore company, received certain AMC charges. The question was regarding the taxability of these AMC charges. The assessee took the position that the AMC charges are in the nature of business income, and because it does not have a PE in India, the AMC charges are not chargeable to tax. The department adopted a rather interesting approach in this case. So what the department did was, they did not really call for a lot of information from the assessee. They also did not pursue the distributor. What the department did was, they issued summons to the customers of the assessee in India, the third parties. So the employees of the customers were summoned and their statements were recorded. So the assessing officer asked those employees as to what is the involvement of this distributor, so as to come to a conclusion whether the distributor constitutes a permanent establishment in India or not. It recorded statements of the employees of the customers. Those employees said that the distributor is in fact the face of this non-resident in India, that we only interact with the distributor, he acts as the representative. Those employees also in their statements said that this distributor also maintains a stock of inventory of the Singapore assessee. So the department came to a conclusion that because this distributor in its premises, is maintaining a stock of goods of the assessee, the premises of the distributor constitutes a fixed place permanent establishment. And the department also said that the distributor also constitutes a dependent agent permanent establishment in India, because it habitually concludes contracts on behalf of the non-resident. It also maintains inventory of goods of non-resident from which it makes delivery, and it also secures orders for the non-resident. When the matter reached the tribunal, the assessee said that the statements which have been recorded are of third parties, are of the customers. These employees of the customers do not know what the relationship between the assessee and the distributor is. In any event, the assessee said these statements were neither confronted to it, nor was the assessee given an opportunity to cross-examine these people. So the assessee, normally we have these arguments in search cases in 68, 69, that if statement of a third party has been recorded and you've not been given an opportunity to cross-examine these third parties, then these statements do not carry any evidentiary values. Bombay, Delhi High Court in Best Infrastructure, Rajiv Agarwal, etc. The tribunal agreed with the assessee. It applied the same ratio and said that because these statements were recorded behind my back and I did not get an opportunity to cross-examine these people, this statement cannot constitute evidence for concluding my permanent establishment in India. The ITAT also said that onus is on for proving the existence of a permanent establishment in India, the onus is always on the department. They relied on the Supreme Court judgment in e-funds, which was subsequently followed in Samsung Heavy Industries. So the tribunal said that because this statement has no value and the onus is on you, and you've not been able to prove with any other material fact that the distributor does in fact carry out all these functions on behalf of the assessee, so there is no PE. For fixed place PE, the tribunal said that the stock which was being stored at the premises of the distributor was distributor's own stock, because distributor had purchased these goods on a principal to principal basis from the assessee. This was not assessee's inventory, this was the distributor's inventory. So the assessee was not utilizing the fixed place of the distributor. For dependent agent P, also the tribunal said that there is no material with the department to conclude that the distributor is either concluding contracts on behalf of the assessee, or it's securing orders for the assessee, or it is maintaining inventory for the assessee from which it is debiting. So the tribunal, for these reasons, decided the issue with the assessee's favor. The next decision is of the Surat Tribunal in the case of Star Rays. This decision also, before the tribunal, a very interesting question was raised as to what is the binding nature of Form 15CA, 15CB that we file. So if we make some mistake while filing this form, are we bound as a deductor? Are we bound by what we said in Form 15CA, 15CB, or can we resile from it and say that what we mentioned in that form is not the correct position? This was the issue before the tribunal. The facts were like this. The assessee was engaged in the business of cutting and polishing of diamonds and then eventually exporting them. Sometimes if a customer would request the assessees to provide to get these diamonds certified from a credible authority, assessee then would contract with Gemological Institute of America, which is a very well-renowned authority for certifying the quality of diamonds, which is in USA. So assessee would enter into an agreement with GIA USA, under which the terms were like this. The assessee would send the diamonds to a place in Hong Kong, which was under GIA USA's control. So this place was called a take-in window. The assessee would send its diamonds to Hong Kong, and Hong Kong would in turn send the diamonds to GIA USA. Then GIA USA will examine the quality of these diamonds and then prepare a report and give a grading of the quality of the diamonds. The other relevant term in this entire arrangement was that payment was to be made to GIA USA, but not in its bank account in USA, but its offshore bank account in Hong Kong. So two activities were being carried out at Hong Kong. One was take-in window for accepting these diamonds for onward transmission to USA. And the second activity in Hong Kong was that it was the GIA USA's offshore account in Hong Kong wherein this money was to be deposited for getting these services. While filing Form 15CA, 15CB, the assessee mistakenly wrote the name of GIA Hong Kong as the recipient. Although the agreement was with GIA USA, the assessee by mistake wrote GIA Hong Kong to be the recipient. Now, when these payments were to be made to GIA USA for giving these certification services, the assessee took the position that this income is in the nature of fees for included services in the hands of GIA USA. And because of India-US treaty, because of clause B in Article 12, which says that unless something is made available, unless technical experience, know-how, skill is made available, income cannot be taxed like SFIS. So the assessee, while deducting tax, said that this income is not taxable in the hands of GIA USA because make available is not satisfied. No tax is required to be deducted. The assessing officer took the position that what you are, because in your form 15 CA 15 CB, what you've written is that you are making payment to GIA Hong Kong, not GIA USA. So you cannot apply, while determining what the taxability or the nature of this income in the hands of the recipient is, you cannot apply India-US treaty. You can only look at Hong Kong. Hong Kong at that time did not have a treaty with India. Hong Kong's treaty came only in 2018. So because there was no treaty between India and Hong Kong, the AO said that we have to look at the taxability of this income in the hands of the recipient under the Act. And under the Act, it is fees for technical services. So you should have deducted tax at source. Because you've not made a deduction, they initiated 201 proceedings against this assessee. The tribunal eventually decided this issue in the assessee's favor. So what the tribunal said was, it said that 15 CA, 15 CB is only part of a procedural compliance. It does not carry any legal force. So even if you made a wrong statement in Form 15 CA, Form 15 CB, it will not bind you. So certainly it will not bind the recipient if you are carrying out the assessment of the recipient. What the deductor writes in Form 15 CA, 15 CB is certainly not relevant. But even while carrying out 201 in the hands of the deductor, you cannot just plainly rely on Form 15 CA, 15 CB. You have to look at the actual factual position. The tribunal then noted that in this case, the agreement was between India and GIA USA. The grading report used to come from GIA USA, not GIA Hong Kong. And also the payments were eventually made to GIA USA's bank account, although that bank account was in Hong Kong, but the recipient was definitely GIA USA. So the tribunal said that we'll apply India-US treaty, and because in India-US treaty, the condition of make available is not being satisfied, this income is not taxable in the hands of GIA USA. So therefore, 201 proceedings were to be quashed. The next decision is of the Kolkata Tribunal in the case of Rajat Dhara. There were two issues before the tribunal. One was a legal issue and one was a factual issue. In this case, the assessee was a resident of India. So in the relevant year, it had spent 200 days in India and 165 days in USA. Because apart from the activities that it was carrying out in India, it was also employed by a company in USA. So it spent 165 days in USA and 200 days in India. The assessee said that the income that I received from my USA employer is not taxable in India by virtue of Article 16 of India-US Treaty. Under the Act, it is certainly taxable because he's a resident. World income is taxable under the Act. But he relied on Article 16 of India-US Treaty to say that income is not taxable in India. The department said that assessee, because the assessee is a resident because his stay in India during the year was more than 182 days. So because he's a resident, he cannot claim any benefit from Indian tax authorities by invoking India-US Treaty. How the AO interprets the treaty is, he says that if India-USA Treaty is being invoked by an Indian resident, then that Indian resident can only get some benefit from the US authorities. Indian resident cannot get any benefits from Indian authorities by invoking India-US Treaty. Conversely, if a USA resident is invoking India-US Treaty, then the USA resident will get some benefit from Indian tax authorities. USA resident cannot get benefit from US authorities by invoking India-US Treaty. So the AO said that because you're an Indian resident, you cannot get any benefit from Indian authorities. You cannot get any exemption, any relaxation from Indian authorities by invoking any article in India-US Treaty. this was the first legal question before the tribunal. The tribunal saw the language of Section 90 as also the treaty and said that there is nothing in the treaty which supports this interpretation of the department. The tribunal said that an Indian resident can invoke treaty to get any relief, whether it be from tax to be paid in India as well as tax to be paid in USA. So once you're a resident, you're entitled to claim treaty for tax paid in either of the contracting states. This position, which this ratio of the tribunal seems fairly correct. There's no doubt about it. Then the tribunal went on to examine the facts of this case, that whether Article 16 is giving any benefit to the assessee or not. If you see Article 16, paragraph 1 says, salaries, wages, and other similar remuneration derived by a resident of a contracting state. In this case, the resident is India, so we'll treat it as remuneration derived by a resident of India in respect of an employment shall be taxable only in that state. So shall be taxable only in India unless the employment is exercised in the other contracting state, that is USA. If the employment is so exercised, such remuneration as is derived therefrom may be taxed in that other state. So paragraph 1 says that if you're an Indian resident and you exercise employment in USA, under first part of paragraph 1, that income will be taxable in India. And under the second part of paragraph 1, such income will also be taxable in the other state, that is USA. So paragraph 1 gives taxing rights to both India as well as USA. Now paragraph 2. Para 2 says, notwithstanding the provisions of paragraph 1, remuneration derived by a resident of India in respect of an employment exercised in USA shall be taxable only in the first mentioned state, that is only in India. If, and then there are 3 conditions. So para 1 gives taxing rights to both countries, and para 2 says that income will be taxable only in India if these conditions are satisfied. So whether you apply para 1 or you apply para 2, income had to be taxable in India. Para 2 only gives relaxation from paying tax in USA. Both paras 1 and 2 say that income has to be taxable in India. But the tribunal, in this case, just reproduced the facts of the case, and it's not a very detailed order. They've not really dealt with the issues, but they came to the conclusion that by applying paragraph 1 and 2 of Article 16, this income is not taxable in India, which from the language of the treaty does not seem plausible. Now, the tribunal does not really give a reason as to why it says that the income is not taxable in India. Perhaps one reason that could have weighed with the tribunal was that when paragraph 1 says that if the employment is so exercised, such remuneration as is derived therefrom may be taxed in that other state, that is, may be taxed in USA. Perhaps the tribunal felt that once income is taxed in the other state, may be taxed in the other state, the sequitur is that income cannot be taxed in India. That may be taxed in the other state means may only be taxed in the other state. Perhaps that was in the mind of the bench. If that be the case, then that line of reasoning is also incorrect. So earlier, this expression may be taxed in the other state was examined by the Supreme Court, was examined by several courts, which eventually was decided by the Supreme Court in 2004 in the case of PVL, Kulangan and Chetiyar, where the Supreme Court had said that if the income is taxed, if the language used is may be taxed in the other state, what it means is it may only be taxed in the other state. So if the Supreme Court's line of reasoning in Chetiyar was to be applied, then the reasoning of the tribunal is correct. That may be taxed in USA means may only be taxed in USA and cannot be taxed in India. But subsequently, this judgment of the Supreme Court was legislatively reversed by the government. So subsection 3 to section 90 says that if there is an expression used in the treaty, and that expression is neither defined in the treaty nor is it defined in the Act, then the government has the power under section 90 subsection 3 to define that expression by a notification. The government came out with a notification in the year 2008 to say that these words may be taxed means that it may be taxed in the other country, but it will also be taxable in the first country. So may be taxed means taxability in both the contracting states. This is what was legislatively defined by the government. Now, this interplay between the notification of the government of 2008 and the Supreme Court's judgment in 2004 was considered by several decisions. The first decision was of the Mumbai Tribunal in the case of Tata Sons, where they said that because it's not an ordinary notification, the government is drawing its power to legislate. It's a case of delegated legislation from the section in itself. So this notification is really a piece of law. So the tribunal concluded that now henceforth may be taxed means that the income will be taxed in both the contracting states. And that decision of Tata Sons was subsequently followed in Technimont by Bombay Tribunal and several other decisions. So if we look at the legal position as it stands today, after 2008, may be taxed means that income has to be taxed in both the contracting states. So therefore, the conclusion of the tribunal in the case of Rajat Dhara that may be taxed means that income is only to be taxed in the second state, that is USA, and it is not to be taxed in the first state, is not correct, does not seem to be correct. The next decision is of the Delhi Tribunal in the case of Ovid Technologies. So this decision deals with characterization of income that is received for granting access to a database. This is also a very contentious issue. So the department usually flip-flops. In some cases, the department takes the position that when you grant access to your database, what you're receiving is royalty. In some cases, department takes the position that what you're receiving is really FTS. Apart from a couple of tribunal and AR decisions, most of the jurisprudence seems to be in the assessee's favor to say that granting access to database is neither FTS nor is it royalty. It's in the nature of business income only. And if the recipient, the non-resident recipient, does not have a permanent establishment in India, such an income earned for granting access to a database cannot be taxed in India. Now, the reason this decision is important is because in this decision, the tribunal relied on the Supreme Court's judgment in the case of engineering analysis, which was in the context of software royalty, to say that when you are granting access to your database, what the service recipient is getting is only a product or a service. It is not getting access to the underlying technology which runs the database. It cannot exploit that underlying technology. So it's only getting a product or a service, which is also what the Supreme Court had held while dealing with software royalty. So the tribunal said that applying engineering analysis, this income is neither in the nature of royalty, nor is it in the nature of FTS. It's in the nature of business income. And because the assessee does not have a PA in India, this income is not taxable in India. The next decision is also similar to the decision that we just discussed. This is in the case of Microsoft Regional Sales Pte. Limited. In this case, Microsoft had granted cloud computing storage to its subscribers in. So what happens when you subscribe to, let's say, Google or Microsoft's cloud services? What essentially happens is that your information, your data is transmitted through internet and it is stored in a physical data center in an infrastructure somewhere outside India. So the information is still eventually stored in a physical infrastructure only, in a data center only. The assessing officer in this case took the view that when you are granting someone access to your data center by cloud services, you are giving them a right to use the data center. You are giving them a right to use your commercial equipment. So this income that you receive for granting access to from cloud computing services is in the nature of royalty. In this case also, the tribunal relied on the Supreme Court's judgment in engineering analysis to say that when you subscribe to Microsoft's cloud computing services, you do not get a right to exploit the technology which runs that data center, the technology on the basis of which this cloud computing functions. You are only getting a service. That is, you only get to store your data somewhere. You do not know how this infrastructure works. You cannot reproduce it. You cannot create your own data center by exploiting the technology. So in this case also, the tribunal came to a conclusion that this income is not in the nature of royalty, it's not in the nature of FTS, it is business income. And because the assessee does not have a PE in India, this income is not taxable in India. The last decision is of the Bangalore Tribunal in the case of Invendis Technologies India. This was an interesting decision. This decision dealt with several computation aspects of Section 91 of the Act, which is uncharted territory as of now. So in this case, the assessee earned certain income from Ghana. India does not have any treaty with Ghana. So whatever tax credit was to be claimed by India, by the assessee in India, it had to be claimed under Section 91. Now the payer in Ghana, while making this payment to the resident in India, had deducted some tax at source as per the laws in Ghana and had deposited the same with the Ghana authorities. Now if you see Section 91, it says if any person who is a resident in India in any previous year proves that in respect of his income which accrued or arose during that previous year outside India and which is not deemed to accrue or arise in India, he has paid in any country with which there is no agreement under Section 90 for the relief or avoidance of double taxation, income tax by deduction or otherwise under the law in force in that country, he shall be entitled to the deduction from the Indian tax payable by him of a sum calculated on such doubly taxed income of tax or the rate of tax of the said country, whichever is lower, or at the Indian rate of tax if both the rates are equal. So what is required to get the benefit of Section 91 is that firstly, you ought to have paid some tax in the other country. Secondly, the income on which you paid tax in the other country must be a doubly taxed income. So that income must be subject to tax both in India as well as in the other country. If these two conditions are satisfied, then you will get a deduction from your Indian tax liability. The deduction will be the lower of the Indian rate of tax or the rate of tax in the other country. Now this expression, the Indian rate of tax, is defined in the explanation to Section 91 itself. They say that how you calculate Indian rate of tax for the purpose of 91 is you take your total tax that you worked out and you divide it by the total income. Whatever that rate works out is the Indian rate of tax. But this does not explain how the rate of tax in the other countries to be worked out. That is left to the judgment of the assessees and the courts and the AOs. So in this case, the assessee said that if the payer in Ghana had deducted, let's say, 5 rupees while making a payment of rupees 100, they say that rate of tax in Ghana should be 5%. So you take the tax which has been deducted in Ghana and you divide it by the gross receipts by name. The assessing officer said that you have to, because for calculating Indian rate of tax, you have to divide the Indian tax by total income and not by gross receipts. Then similarly, for calculating rate of tax of the other country, you have to divide the tax which has been deducted in the other country by the income assessable in the other country. You cannot divide it by gross receipts. It has to be divided by the income so as to bring parity between these two rates. The tribunal, this was one of the questions before the tribunal. The tribunal said that, agreed with the department to say that you cannot divide the tax paid in the other country by the gross receipts. You have to divide it by the income which has been assessed to tax in the other country. But then the tribunal was faced with a difficulty that if there is no assessment in the other country, then how do you determine the income in the other country which has suffered taxation? So to that, the method that the tribunal accepted was that you calculate the income percentage in India first. So you see what the net profit in India is. You divide it by the gross receipts in India. Let's say it comes to 20%. Net profit in India divided by gross receipts in India comes to 20%. You apply the same percentage to the receipt in Canada. To the receipt in Ghana. So if the amount remitted from Ghana was 100, then by applying the Indian net profit percentage, which is 20%, you assume that the income in Ghana is also 20%. And that will be the income which will form the denominator for calculating the rate of tax in Ghana. That was the first question before the tribunal. The second question before the tribunal was that when you are calculating this Indian rate of tax, would you include surcharge and cess or not? Because the definition of Indian rate of tax is total tax divided by total income. So the tribunal said that, relying on several judgments of the Supreme Court, now it's become, by the amendment of this year, it's become very clear that both cess and both surcharge as well as cess are nothing but tax itself. So the tribunal came to a conclusion that while calculating Indian rate of tax, you have to consider not only tax but also surcharge as well as cess. The last question before the tribunal was that when you work out this net profit percentage, do you just consider the income from operations or do you consider other income also? So the tribunal again said that there is no guidance in section 91. But because while paying tax in India, you have to pay tax on both your regular business income as well as your other income. So for Indian tax, since you have considered other income as also other income, so on the logic of parity, while calculating net profit percentage in Ghana, also you will consider other income in addition to your regular income. So the tribunal decided all these three questions in section 91. That is really the last decision in the presentation. So unless there are any comments or questions,